Welcome to the deep dive. You know we love to get into the nitty-gritty, and today we're tackling a subject that I think a lot of people find fascinating and also maybe a little intimidating,
Yeah,
and that is the stock market.
the stock market.
We've got a whole stack of articles and research, and we're going to help you make sense of it all.
We're going to give you an understanding of how the stock market works, the language it speaks, and some different approaches to investing.
So let's dive in. First and foremost, what is the stock market? We hear about it all the time, but it can feel very abstract.
It's this vast, interconnected network where companies, big and small, offer pieces of themselves for ownership, and this ownership comes in the form of stocks or shares. And these stocks are constantly being bought and sold, and their prices are constantly going up and down.
So it's not just one central location.
No.
Right.
I mean, there are iconic exchanges like the New York Stock Exchange and the NASDAQ, but it's this global concept facilitated by electronic networks that connect buyers and sellers all over the world.
That makes sense. Now, I've always been curious about how these prices are determined. What makes some stocks go way up and others totally plummet?
Well, it's a complex interplay of forces, but one of the most fundamental things that drive stock prices is supply and demand. Just like any marketplace, if the demand for a particular stock exceeds the supply, the price is going to go up. And when there are more people selling than buying, the price is going to go down.
So is that the only thing? Or is it about a company's performance?
Well, a company's financial health and growth prospects, of course, are major drivers. But there are so many other factors that come into play, like economic indicators and industry trends, global events, investor sentiment. All these things can influence stock prices.
So we hear a lot about bull and bear markets. What do those terms actually mean?
Those terms are used to describe the overall mood and direction of the market. So a bull market signifies a period of optimism, rising stock prices. Investors are feeling confident, economic indicators are positive, and companies are generally performing well.
That sounds like a good time to be investing.
It can be. Yeah. But bull markets don't last forever. And eventually sentiment shifts, and we enter a bear market, which is characterized by pessimism, falling stock prices, and economic slowdown.
So it's kind of like a cycle swinging between optimism and pessimism.
Yeah. And understanding those cycles is crucial for investors. And some investors actually thrive in these volatile markets using strategies like something called short selling, where you can actually profit from falling prices.
What is short selling? I've heard that term, but I don't really know what it means.
So short selling is you borrow shares of a stock that you believe is going to decline in value, you sell those shares at the current market price, and then you buy them back later at a lower price to return to the lender.
So you're essentially betting on the price going down.
Yeah.
That sounds pretty risky.
It can be very risky. It's a more advanced strategy that requires very careful analysis and risk management, but it does highlight that there are different approaches to navigating the stock market, depending on your goals and your risk tolerance.
Speaking of, there's a lot of specialized jargon. I know I get a little overwhelmed by it sometimes. What are some key terms we should know?
So many. I guess a good one to start with is market capitalization, or market cap. It's a pretty simple concept. It represents the total value of a company's outstanding shares. So it's basically just a measure of the company's overall size and worth in the market.
So a higher market cap generally means a larger, more established company?
Right. Another key term is ticker symbols. And those are the unique codes that are used to identify companies that are listed on the exchanges. So, AAPL represents Apple, TSLA is Tesla, these symbols just allow for quick and easy identification of stocks in trading platforms and financial news.
Okay, starting to make sense of the language a little bit. Now, are there different kinds of stocks?
Yes, absolutely. Not all stocks are created equal, and the most common types that you'll encounter are common stock and preferred stock.
Okay, let's break down those two then. What is common stock?
Common stock is what most people think of when they think about stock. It represents ownership in a company, and it gives you voting rights.
So if I own common stock in a company, I get to vote.
Yeah, you get to vote on things like who sits on the board of directors.
Wow.
Yeah. Typically, each share of common stock is going to entitle you to one vote. And common stockholders also have the potential to receive dividends, which are a portion of the company's profits that are distributed among the shareholders.
It's like getting a little bonus just for being a part owner of the company.
Exactly. Although it's important to note that not all companies pay dividends. Some companies, especially younger, growth-oriented companies, might choose to reinvest those profits back into the business instead of distributing them to shareholders.
That makes sense. So what about preferred stock? How is that different?
Preferred stock is kind of like a hybrid between a stock and a bond. And so it typically doesn't come with voting rights, but it offers a fixed dividend payment that's similar to the interest payments that you would get on a bond.
So it's a little more stable, predictable income stream.
Yeah, in a way. And preferred stockholders also have a higher claim on the company's assets than common stockholders in the event of liquidation.
Liquidation, what does that mean?
So liquidation is when a company is forced to sell all of its assets to pay off its debts. It's essentially the worst case scenario for a business. So in that situation, the preferred stockholders would get paid before the common stockholders.
So there's like a hierarchy of who gets paid if things go south?
Yes, definitely.
That's good to know. So let's say I'm ready to start dipping my toes into the stock market. Where do I even begin?
That's a great question. And I think the first step is to really define your financial goals. So what are you hoping to achieve by investing in the stock market? Are you saving for retirement? Maybe a down payment on a house? Your children's education?
It's like having a roadmap before setting out on a journey.
Yes.
You need to know where you're headed.
And your goals will help determine your investment timeline, your risk tolerance, and the types of investments that align with your overall financial plan.
Okay. So goals are set. What's next?
So once you have a clear understanding of your goals, you're going to need to choose a brokerage account. A brokerage account is essentially a platform that allows you to buy and sell stocks and other investments. And there are tons of options available. You've got your traditional full-service brokerages to these online platforms like Robinhood and Fidelity and Schwab.
How do I choose the right one for me?
It really depends on your needs and your preferences. So if you're comfortable managing your own investments and you prefer a more DIY approach, online platforms can be great. They tend to have lower fees, they offer more user-friendly interfaces. But if you prefer more personalized guidance, you might consider a full-service brokerage, although, they typically come with higher fees.
Okay. So let's say I've done all that, I've set my goals, I've chosen a brokerage, and now I'm sitting in front of my computer and I'm ready to make my first investment. How do I decide what stocks to buy?
That's where things can get a bit overwhelming, especially for beginners. But there are strategies to make the process a little bit less daunting. One common approach is to start with index funds or exchange-traded funds.
Index funds, ETFs, I've heard those terms, but I'm not quite sure what they mean.
Think of an index fund or ETF as a basket of stocks, and that basket is tracking a specific market index, like the S&P 500 or the NASDAQ 100. So instead of buying individual stocks, you're essentially buying a diversified portfolio with a single purchase.
So it's spreading your bets across multiple companies.
Exactly. Diversification is a key principle of investing because it helps you reduce your risk by spreading your investments across different companies, different industries, and asset classes.
Okay, that makes sense. But how do I choose the right index fund or ETF? There are so many options out there.
Yeah, there are. It comes back to your goals and your risk tolerance. So if you're saving for retirement and you have a longer time horizon, you might consider an index fund that tracks a broad market index like the S&P 500. But if you're looking for more targeted exposure to a specific sector or theme, there are ETFs that focus on areas like technology or healthcare or renewable energy.
Fascinating. So with index funds and ETFs, I don't necessarily have to worry about picking individual stocks right away.
You don't. Those are great starting points. But as you gain more experience and confidence, you can definitely explore individual stock picking. But even then, diversification is still going to be crucial.
So even if I'm like really, really excited about a particular company, it's not wise to put all my money into it.
It's not a good idea.
Okay. Don't put all your eggs in one basket. Got it. Now, what about timing investments? Is there a right time to buy or sell stocks?
That is the million-dollar question, isn't it? I wish I had a crystal ball to predict market movements, but trying to perfectly time the market is extremely difficult, and it can often lead to missed opportunities and some costly mistakes.
So what do I do? Just invest whenever I have some extra money?
A popular strategy that can help mitigate the risks of trying to time the market is called dollar cost averaging.
Dollar cost averaging, what is that?
So with dollar cost averaging, you're investing a fixed amount of money at regular intervals. So it doesn't matter if the market is up or down, you just stay consistent. And that way you're naturally buying more shares when the prices are low and fewer shares when the prices are high.
Ah, So you're kind of taking advantage of the market fluctuations without having to like monitor every dip and surge.
Exactly. It's a more disciplined approach. It helps average out your purchase price over time and
Yeah.
potentially reduce the impact of market volatility.
That sounds like a very smart strategy for someone who's just starting out.
Yeah, it's very common for both new and seasoned investors. Consistency and discipline are really key to long-term investing success.
Now, we've been talking a lot about the kind of mechanics of investing. I want to circle back to something you mentioned earlier, this idea of risk tolerance. What does that actually mean?
So risk tolerance refers to your capacity and willingness to withstand fluctuations in the value of your investments. So it's essentially a measure of how comfortable you are with the possibility of losing money.
So, someone with a high risk tolerance is okay with potentially bigger swings in their portfolio value?
Yes, exactly. And they might be more comfortable investing in like growth stocks or emerging markets, which tend to be more volatile. On the other hand, someone with a lower risk tolerance, they might prefer more stable investments like bonds or dividend-paying stocks.
Mm, got it. So, understanding my own risk tolerance is important for choosing the right investments for my portfolio. But how do I actually figure out what my risk tolerance is?
There are a lot of questionnaires and tools available online that can help you assess your risk tolerance. And it often involves considering factors like your age, your financial goals, your time horizon, and really your emotional response to market fluctuations.
So, a younger investor, maybe someone with a longer time horizon, is more likely to take on more risk than someone who's nearing retirement.
That's a very common scenario because a younger investor has more time to recover from potential losses, whereas someone who's nearing retirement might really prioritize preserving their capital and maybe generating a steady income stream.
Okay, so it sounds like all these pieces really fit together. Your goals, your risk tolerance, your timeline, all these factors come into play.
Absolutely.
Now, of course, investing can be nerve-wracking, and there are inherent risks involved.
Of course.
So let's talk about the good, the bad, and the potentially ugly. What are the benefits and risks of investing in the stock market?
Well, historically, the stock market has been one of the most powerful engines for wealth creation. It has consistently outperformed other asset classes, like bonds or savings accounts, over the long term. So this potential for growth is a major draw for investors who are looking to build their financial futures.
So the idea is that over time, your investments have the potential to grow significantly.
That's right. And one of the key factors that drives this growth is the magic of compounding returns. It's this really cool concept where your earnings generate their own earnings over time, which leads to this exponential growth effect.
I love that. It's like a snowball effect for your money.
Yeah.
But we have to talk about the downsides, right?
Yeah. It's important to be realistic about the risks involved, and investing in the stock market does come with inherent risks. So one of the most significant risks is market volatility. As we discussed, stock prices can fluctuate significantly in the short term, driven by a wide range of factors.
So even if a company is doing well, its stock price could still go down.
That's right, yeah. Market sentiment, economic conditions, or even geopolitical events can impact stock prices,
Right.
sometimes independently of a company's actual performance. This is why it's so crucial to have a long-term perspective and not panic during those short-term market swings.
So patience and discipline are essential qualities for an investor.
Absolutely essential. Another risk to be mindful of is emotional investing. Fear and greed can drive impulsive decisions, leading people to buy high and sell low, which is the exact opposite of what you want to be doing.
So even when things get a little scary, you have to stick to your plan.
You do. Having a well-defined investment strategy, understanding your risk tolerance, staying informed about market trends, it can all help you navigate these challenges and make more rational decisions.
This has been an incredibly insightful dive into the stock market. I feel like I have a much clearer understanding of how it all works. Any final words of wisdom for our listeners who are eager to embark on their investing journey?
I think the biggest thing I would say is to emphasize the importance of continuous learning. The world of investing is vast, and it's constantly evolving, so stay curious.
Yeah.
Read books, follow reputable financial news sources, and don't be afraid to ask questions. Knowledge is your most valuable asset in this journey.
Well said. It's been a pleasure exploring this topic with you today. To our listeners, we hope you've enjoyed this deep dive as much as we have. And remember, even understanding the basics is a huge step towards taking control of your financial future.
Absolutely.
Yeah.
And, as we always say, happy investing. Well, historically, the stock market has been one of the most powerful engines for wealth creation.
It has, huh?
Yeah. It has consistently outperformed other asset classes,
Like what?
like bonds or savings accounts, over the long term.
Okay.
So this potential for growth is a major draw for investors who are looking to build their financial futures.
So the idea is that over time, your investments have the potential to grow significantly,
That's right.
like exponentially.
And one of the key factors that drives this growth is what's called the magic of compounding returns.
Okay, break that down for me.
So compounding returns is a really cool concept where your earnings generate their own earnings over time,
Okay.
and that leads to this exponential growth effect.
I love
It's
that.
almost like a snowball effect for your money.
Yeah, it is. But of course, we have to be realistic about the risks.
Of course.
Investing in the stock market does come with inherent risks.
It does.
What are some of those?
One of the most significant risks is market volatility.
Right.
As we discussed, stock prices can fluctuate significantly in the short term,
Yeah.
driven by a wide range of factors.
So even if a company's doing well, its stock price could still go down.
That's right. Yeah.
Wow.
Market sentiment, economic conditions, or even geopolitical events can impact stock prices,
Right.
sometimes independently of a company's actual performance.
Got it.
This is why it's so crucial to have a long-term perspective and not panic during those short-term market swings.
So patience and discipline are essential qualities for an investor.
Absolutely essential.
You have to kind of ride the waves.
You do.
What other risks are there?
Another risk to be mindful of is emotional investing.
Okay.
Fear and greed can drive impulsive decisions, leading people to buy high and sell low, which is the exact opposite of what you want to be doing.
Oh, for sure. Buy low, sell high, right? So
Right.
even when things get a little scary, you have to stick to your plan.
You do.
You can't just freak out and sell everything when you think the market's going to crash.
Exactly.
So how do we avoid that?
Having a well-defined investment strategy,
Okay.
understanding your risk tolerance, staying informed about market trends,
Got it.
all these things can help you navigate these challenges and make more rational decisions.
This has been an incredibly insightful dive into the stock market.
Good.
I feel like I have a much clearer understanding of how it all works.
Awesome.
Any final words of wisdom for our listeners who are eager to embark on their investing journey?
I think the biggest thing I would say is to emphasize the importance of continuous learning.
Okay.
The world of investing is vast, and it's constantly evolving.
Right.
So stay curious, read books,
Yeah.
follow reputable financial news sources,
Makes sense.
and don't be afraid to ask questions.
Don't be afraid to ask questions.
Knowledge is your most valuable asset in this journey.
So well said. It's been a pleasure exploring this topic with you today. To our listeners, we hope you've enjoyed this deep dive as much as we have. And remember, even understanding the basics is a huge step towards taking control of your financial future.
Absolutely. And as we always say, happy investing.
Yeah.
Absolutely. And as we always say, happy investing.
So to wrap up today's deep dive, we've really gone deep into what the stock market is and how it works. We talked about all those sometimes confusing terms like bull and bear markets and market cap and ticker symbols. And we even took a look at some basic investing approaches like dollar cost averaging and my favorite, diversification.
Yeah. Diversification.
Huh.
Never put all your eggs in one basket.
Exactly. And I think what's been really cool about this deep dive is that, we started out talking about how intimidating the stock market can seem to a lot of people, but hopefully we've demystified it a bit.
Yeah. I think that's so important, and I think people need to realize that investing is not just for the Wall Street elite.
Right. It's for anyone who's willing to learn and, do their research and take a little bit of risk.
Exactly. And remember, you don't have to be an expert to get started. There are so many resources available to help you.
Yeah, that's so true. There are tons of books, websites, even podcasts like this one.
That's right.
So if you're feeling inspired to start investing, just take that first step and who knows, you might be surprised at what you can achieve.
You might be.
So to our listeners, as always, thanks for tuning in to the deep dive. We'll see you next time.